While most investors were distracted by headline inflation prints, election noise, and daily equity swings, something far more consequential moved quietly in the background. It wasn't a crash. It wasn't a rate hike. It wasn't even a dramatic announcement. It was a single technical decision inside China's financial system, one that altered the flow of global dollars just enough to expose how fragile U.S. liquidity had quietly become. Here is the core event in one sentence. China adjusted the way it manages offshore dollar liquidity, and that shift removed a marginal but critical source of global dollar supply at the exact moment the U.S. system could least afford it. At first glance, this sounds abstract. It doesn't show up on a stock ticker. It doesn't trend on social media. There was no emergency press conference. That's precisely why most people missed it. Modern financial stress rarely begins with explosions. It begins with plumbing. For more than a decade, the global system has relied on an informal arrangement. Countries with large trade surpluses, China foremost among them, recycle excess dollars back into global markets. Sometimes this happens through U.S. treasuries, sometimes through bank deposits, repo markets, or offshore dollar lending via Hong Kong, London, and Singapore. The exact channel matters less than the function. Those dollars act as lubricant. They reduce funding stress. They keep spreads tight. They allow leverage to roll over smoothly. Now here's the part most people miss. The U.S. financial system is no longer flush with excess liquidity. Between 2022 and 2024, the Federal Reserve drained roughly $1.1 to $1.3 trillion from the system through quantitative tightening, depending on the measurement window. Bank reserves fell. Reverse repo balances collapsed from over $2 trillion at their peak to a few $100 billion. Treasury issuance surged, with gross issuance running above $20 trillion annually, and net issuance remaining elevated due to persistent fiscal deficits in the $1.5 to $2 trillion range. That meant the margin for error was already thin. China's decision, whether framed as tighter control over capital outflows, reduced offshore dollar lending, or a reprioritization of domestic liquidity, did not need to be large to matter. Even a $5,100 billion shift in available offshore dollars, spread across trade finance, repo markets, and bank balance sheets, is enough to create stress when the system is levered and timing sensitive. This is where the forcing mechanism enters the story. Global dollar liquidity is not evenly distributed, and it does not adjust smoothly. When one large supplier steps back, even slightly, the adjustment does not happen through prices alone. It happens through availability, through collateral haircuts, through higher funding costs, through dealers stepping away at the wrong moment. What's at stake is not just market volatility. It's the ability of the U.S. system to fund itself cheaply while running large deficits, maintain stable treasury markets, and prevent small funding frictions from cascading into broader risk-off events. Liquidity shocks don't announce themselves as crises. They surface as failed auctions, sudden spread widening, unexplained volatility spikes, and forced selling in places that shouldn't be correlated. Before going further, an explicit disclaimer is necessary. This discussion is for educational purposes only. It is not financial advice. Financial markets involve significant risk, and interpretations of macroeconomic dynamics are inherently uncertain. Consult qualified professionals before making financial decisions. Now here's where it starts to get uncomfortable. Because once you see how this mechanism works, the question is no longer whether a shock occurred. The question becomes why the system was so exposed to it in the first place. And that takes us directly into the mechanics. To understand why a single decision in China could ripple into a liquidity shock in the United States, you have to strip away headlines and focus on mechanics, not opinions, not narratives, balance sheets, funding chains, and timing constraints. This is the plumbing layer of the global financial system, and it's where stress accumulates long before prices react. Start with the foundation. The US dollar is the world's primary funding currency. Roughly 85 to 90% of global FX transactions involve the dollar on one side. More than $12 trillion in non-US debt is denominated in dollars, according to BIS estimates. That means banks, corporations, commodity traders, and governments outside the US need dollars continuously, not occasionally, to roll debt, settle trade, and hedge exposures. Those dollars come from three main sources. First, the Federal Reserve via swap lines and domestic liquidity. Second, U.S. capital markets through treasuries, credit, and equity flows. Third, and this is the underappreciated piece, trade surplus recycling, especially from countries like China. For years, China's export machine generated large net dollar inflows. At its peak in the mid-2010s, China's current account surplus exceeded $300 billion annually. Even in more recent years, with slower growth and rebalancing, the surplus has ranged roughly $200 to $400 billion depending on the year and accounting method. Those dollars don't sit idle. They move through banks, trade finance, FX swaps, and offshore lending markets. Here's the key mechanism. Offshore dollar liquidity does not behave like central bank money. It is created and destroyed through balance sheet decisions. When Chinese authorities allow banks and firms to lend or swap dollars freely offshore, global funding conditions ease. When they restrict, retain, or redirect those dollars inward, whether to stabilize the yuan, support domestic credit, or manage capital flight, global dollar liquidity tightens. Now layer in timing. Between 2022 and 2024, the Federal Reserve ran quantitative tightening at roughly $95 billion per month at peak pace. Over that window, bank reserves declined materially. Meanwhile, U.S. Treasury issuance surged to fund persistent deficits. In 2024 alone, net Treasury issuance was on the order of $1.6 to $1.8 trillion by most estimates. That supply had to be absorbed by private balance sheets. Under normal conditions, that absorption is smoothed by repo markets. Dealers finance treasuries overnight. Money market funds provide cash. Foreign institutions recycle dollars. But when one leg weakens, the system compensates elsewhere, until it can't. Now imagine a concrete numerical example. Suppose offshore markets previously had access to $100 billion in rolling short-term dollar funding linked to Chinese trade flows and bank activity. If policy changes reduce that by even 30-40%, that's $30-40 billion less funding availability. That might sound small relative to a $25 trillion treasury market, but liquidity stress is not about totals, it's about margins and timing. If that $30-40 billion shortfall hits during a heavy treasury auction cycle, say weeks with $150-200 billion in gross issuance, dealers must either expand balance sheets or step back. Expanding balance sheets requires funding. Funding requires repo. Repo rates rise. Haircuts widen. Suddenly, holding treasuries is less attractive not because of credit risk, but because of financing risk. This is where the feedback loop starts. Higher repo rates push leverage holders to reduce positions. Reduction means selling. Selling pushes yields higher. Higher yields reduce mark-to-market values, triggering margin pressure. Margin pressure forces more selling. None of this requires panic. It requires math. Now here's the part most people misunderstand. The Federal Reserve does not automatically offset this kind of shock. Swap lines exist, but they are reactive and discretionary. Standing repo facilities exist, but stigma and operational frictions limit immediate use. The system is designed to work smoothly when liquidity is abundant, not when multiple drains operate simultaneously. China's decision didn't cause all of this on its own. It acted as a removal of slack. Think of the system like a suspension bridge under load. For years, excess liquidity acted as extra cables. Removing one cable doesn't collapse the bridge, but if traffic is heavy and wind is strong, stress redistributes fast. This is why market reactions often look irrational at first. Assets that should benefit from higher yields sell off. Correlations spike. Volatility appears without a clear headline catalyst. Observers blame sentiment. The real cause is structural. And this leads directly to the next question. Who is forced to act when liquidity tightens and who has no choice at all? That's where pressure turns into risk. Once liquidity tightens, markets stop being democratic. Not everyone reacts at the same time, and not everyone has choices. The system doesn't break where it's weakest emotionally. It breaks where balance sheets are constrained, leverage is embedded, and deadlines are non-negotiable. That's why understanding who is forced matters more than understanding who is right. Start with the primary pressure point, financial intermediaries. Dealers, banks, and large market-making institutions sit at the center of the Treasury and repo ecosystem. They are required to intermediate massive flows, but they do so under capital constraints. Post-2008 regulations capped balance sheet expansion. Supplemental leverage ratios, risk-weighted asset limits, and internal stress tests mean dealers cannot simply step in when volatility rises. When offshore dollar liquidity tightens, even marginally, repo funding becomes more expensive and less reliable. That immediately pressures dealers who rely on overnight financing to warehouse treasuries. If repo rates move from, say, 5.3% to 5.8% in a short window, that 50 basis point shift matters when margins are thin and positions are large. The choice becomes binary, either reduce inventory or accept balance sheet strain. Most choose the former. Next are leveraged funds. Hedge funds running relative value trades, basis trades, or curve steepener strategies are structurally sensitive to funding costs. Many of these trades work only if financing remains cheap and stable. A treasury basis trade, for example, might generate 20-40 basis points of annualized return, but only when leverage is high and funding is smooth. Increase haircuts by even 1 to 2 percentage points, and the return profile collapses. That's not a discretionary decision. Margin terms are contractual. When funding desks demand more collateral, funds must comply or unwind. This is where forced selling enters the system, not because someone changed their macro view, but because the math no longer works. Then there are foreign institutions. Non-US banks and asset managers hold trillions in dollar assets funded partially through FX swaps. When offshore dollar supply tightens, FX swap bases widen. A negative basis of minus 20 basis points moving to minus 60 or minus 80 is not theoretical. It has happened before. That move raises the effective cost of holding dollar assets for foreign investors. Again, the choice becomes binary: hedge at a loss or reduce exposure. Now zoom out to the real economy. Large importers, especially in energy, industrial metals, and technology supply chains, depend on dollar financing for trade settlement. A disruption in short-term dollar availability increases working capital costs. For firms operating on thin margins, that means either drawing down inventories or passing costs forward. That's how liquidity stress quietly becomes inflation pressure or supply disruption, even without demand shocks. Here's the historical parallel that matters most. September 2019. Repo markets seized seemingly out of nowhere. Overnight rates spiked to nearly 10% despite no recession, no credit crisis, and no obvious catalyst. The trigger was a combination of treasury issuance, corporate tax payments, and balance sheet constraints. The similarity is structural, not contextual. The difference now is scale. Deficits are larger. Debt outstanding is higher. Global leverage is deeper. The uncomfortable truth is this: someone is always trapped when liquidity tightens. It's rarely households first. It's institutions with leverage and deadlines. They don't wait for clarity. They act because they must. This is why shocks propagate faster than narratives. By the time the story is clear, positioning has already shifted. Now here's where the argument either holds or falls apart. Because pressure alone doesn't prove systemic risk. Data does. The next step is to look at the numbers that show why this wasn't noise, and why normal expectations fail under these conditions. Up to this point, everything could still be dismissed as narrative. Liquidity feels tight. Funding seems stressed. Volatility looks jumpy. But markets don't break on feelings. They break when balance sheet math no longer clears. This chapter is where the story either collapses or becomes unavoidable. Start with the U.S. government's financing reality. Since 2020, U.S. federal deficits have averaged roughly $1.7, $2.2 trillion per year, even outside recession. Total marketable Treasury debt outstanding now exceeds $26 trillion, up from about $17 trillion in 2019. That's an increase of roughly $9 trillion in 5 years. Servicing that debt matters. At an average interest cost, moving from near 1.5% toward 3.5 to 4.0%, annual net interest expense alone is trending toward $900 billion to $1.1 trillion depending on rate paths. That's no longer a rounding error. It competes directly with defense and entitlement spending. Now overlay liquidity. Bank reserve balances at the Federal Reserve peaked near $4.3 trillion in 2021. By late 2024, they had fallen closer to the $3.3 trillion range, depending on classification. At the same time, usage of the Fed's overnight reverse repo facility collapsed from over $2.3 trillion to well under $500 billion. That decline is often interpreted as excess liquidity being absorbed. In reality, it means the buffer is gone. When the buffer disappears, marginal flows matter. Here's where China re-enters the data story. China's foreign exchange reserves peaked near $4 trillion in 2014 and now sit closer to $3.1, $3.3 trillion. That decline reflects years of intervention, capital management, and reallocation. More importantly, the composition and mobility of those reserves changed. Fewer dollars circulate freely through offshore banking channels. More are retained domestically or deployed strategically. Assume 3 simplified scenarios to illustrate why this matters. Scenario A, status quo assumption. Offshore dollar recycling remains stable. China-related flows provide roughly $120 billion annually in net short-term dollar liquidity via trade finance, swaps, and banking channels. In this world, elevated treasury issuance is absorbed with manageable stress. Repo rates fluctuate but remain orderly. Volatility spikes are contained. Scenario B, moderate tightening. Offshore availability drops by $30–50 billion annually. This is not a collapse, just less recycling. In this case, repo markets experience periodic stress during heavy issuance weeks. Bid-to-cover ratios at treasury auctions weaken slightly. Dealers reduce balance sheet usage. Yields rise not because of inflation expectations, but because of financing frictions. Scenario C, severe retrenchment, offshore dollar flows declined by $75–100 billion. This forces U.S. domestic balance sheets to absorb nearly all incremental Treasury supply. Repo spreads widen persistently. FX basis remains deeply negative. Leverage positioning shrinks rapidly. Volatility becomes endogenous. None of these scenarios require a recession. None require panic. They are arithmetic outcomes of supply and funding capacity. Now consider demand. Foreign official Treasury holdings have been roughly flat to down in recent years. Domestic banks are constrained by capital rules. Households cannot absorb trillions in duration risk directly. That leaves asset managers and leveraged intermediaries, precisely the actors most sensitive to funding costs. This is why normal expectations fail here. Investors assume higher yields automatically attract buyers. That's true only if buyers can finance positions efficiently. When funding is scarce, price is not the clearing mechanism. Availability is. This is the part most people miss. Liquidity shocks don't announce themselves through macro data first. They show up in micro signals: repo, FX basis, auction tails, spread behavior. By the time GDP or CPI reflects stress, the market has already repriced. And once repricing begins, feedback loops take over. That's what we need to examine next. How markets usually react once this math becomes unavoidable, and why the reaction often looks chaotic, even though it's structurally logical. When liquidity tightens, markets don't respond in a clean, linear way. They respond through feedback loops, and those loops are often violent, nonlinear, and confusing to observers who are focused on narratives instead of structure. This is why liquidity shocks are frequently misdiagnosed as panic, sentiment shifts, or overreaction. In reality, they are mechanical. The first transmission channel is funding markets. Repo rates begin to rise relative to policy rates. Haircuts increase quietly. Term funding becomes harder to secure. None of this makes headlines. But for institutions dependent on rolling short-term financing, this is the equivalent of oxygen thinning. They don't wait for confirmation. They reduce exposure preemptively. That reduction shows up as selling pressure in assets that are supposed to be safe: treasuries, agency MBS, investment-grade credit. This is the first apparent paradox. Yields rise even as risk increases. Observers ask why bonds are selling off during stress. The answer is simple. Bonds are the collateral of the system. When liquidity is needed, collateral gets sold. Next comes correlation breakdown. Assets that usually hedge each other begin moving together. Equities and bonds sell off simultaneously. Gold may rally briefly, then stall. The dollar strengthens not because of confidence, but because global borrowers scramble for funding. This is not a macro view. It's a balance sheet reflex. As volatility rises, risk models react. Value-at-risk constraints force funds to reduce gross exposure. Risk parity strategies delever because volatility inputs spike. Options desks adjust gamma hedges, which amplifies intraday moves. None of these actors are making discretionary judgments. They are following rules. This is where liquidity shocks accelerate. Bid-ask spreads widen. Depth disappears. Small trades move prices more than expected. ETFs begin trading at premiums or discounts to NAV, not because of mispricing, but because underlying markets cannot absorb flow smoothly. This is the moment when the system feels fragile, even though no single institution has failed. Now here's the key insight. Markets look irrational precisely because they are behaving rationally under constraint. The goal is no longer return maximization. It is survival. Cash becomes valuable not for its yield, but for its optionality. Observers often expect central banks to intervene immediately, but intervention is neither automatic nor instantaneous. Policymakers must first determine whether stress is transient or systemic. They monitor indicators: repo volumes, bid-to-cover ratios, FX basis swaps, credit spreads. Only when dysfunction persists does the policy response activate, and even then, with delay. That delay matters. During the gap between stress emergence and policy response, price discovery overshoots. Weak hands exit. Strong hands wait. Volatility feeds on itself. Importantly, this does not require a collapse in earnings, employment, or consumption. It is a financial phenomenon, driven by funding mechanics rather than fundamentals. This is also why markets can stabilize suddenly once relief appears. A single signal, expanded repo operations, a hint of balance sheet flexibility, or a credible liquidity backstop can reverse weeks of stress in days. Not because problems vanished, but because the funding constraint eased. The mistake most investors make is assuming that market reactions reflect forward-looking macro judgments. In liquidity events, they reflect present-tense balance sheet math. Which brings us to the final question. What happens next, how quickly, and what signals actually matter? That's not about prediction. It's about scenario mapping. By the time a liquidity shock becomes visible to the public, the system is already adjusting. The relevant question is no longer, did something break? It's how the adjustment resolves, over what timeline, and through which channel. Liquidity events do not end in a single outcome. They resolve through scenarios, each defined by constraints, incentives, and institutional response speed. Start with the timeline, because liquidity operates on compressed horizons. Next 24 to 72 hours. Stress manifests first in funding markets. Repo volumes thin. FX swap bases widen. Treasury auction results show subtle weakness. Higher tails, lower bid-to-cover ratios. Volatility indices rise even without large index moves. These are early warning signals, not conclusions. Next 1-2 weeks, asset managers and leveraged funds adjust positioning. Gross exposure declines, correlations increase. Price moves accelerate in both directions as liquidity thins. Media narratives begin to form, but they lag the mechanics. Policymakers observe, not act. Next 1 to 3 months, either liquidity stabilizes through market self-adjustment or policy intervention becomes unavoidable. This is where scenarios diverge. Now the 3 scenarios. Scenario 1, base case, manage stress. In this outcome, offshore dollar tightness persists but does not worsen materially. Treasury yields remain elevated but orderly. Repo markets function with higher volatility but no seizure. China maintains tighter control over dollar recycling, but U.S. markets adapt through higher yields and reduced leverage. Key indicators confirming this scenario. Repo rates fluctuate, but remain within 25-50 BPS of policy rates FX basis, stabilizes without continued widening. Treasury auctions clear with modestly higher concessions. Credit spreads widen slightly but remain contained. This scenario implies slower asset price appreciation, tighter financial conditions, and a drag on growth, but no acute crisis. Scenario 2, stress case, liquidity break. Here, offshore dollar availability tightens further, whether through policy reinforcement, capital stress, or external shocks. Funding markets strain under treasury supply. Volatility becomes self-reinforcing. Forced deleveraging accelerates. Key indicators confirming this scenario. Persistent repo stress and elevated fails, deeply negative FX basis, 80 BPS or worse. Sharp widening in credit spreads, disorderly treasury market moves unrelated to macro data. In this case, policy intervention becomes likely, but only after instability becomes undeniable. Scenario 3, relief case, liquidity, backstop. Stabilization occurs through coordinated action. This could include expanded repo operations, regulatory balance sheet relief, or indirect dollar support via swap lines. China may also ease offshore constraints if domestic pressures allow. Key indicators confirming this scenario: repo volumes normalize and spreads compress, FX basis improves materially, volatility declines faster than fundamentals change, treasury market depth recovers. Now the big picture takeaway: this episode is not about China versus the US, it's about system design. A global financial structure built on leverage, short-term funding, and persistent deficits is highly sensitive to marginal liquidity shifts. When buffers are thin, small decisions matter. The real economy adjusts slowly. Financial markets adjust instantly. When the two diverge, volatility fills the gap. And one final reminder, this analysis is educational only. It is not financial advice. Markets involve risk, outcomes are uncertain, and macro dynamics evolve rapidly. Consult qualified professionals before making financial decisions.